Penny Werwa, the Director of Public Relations for the National Reverse Mortgage Lenders Association. Thank you for joining NRMLA and our distinguished speakers for this webinar, a financial option for senior home buyers, understanding HECM for purchase. Today, certified reverse mortgage professionals David Heilman and Jim Cory are going to talk about a financial product uniquely available to presenters who are buyers who are 62 and over that gives them an alternative to paying all cash for a new home or taking a mortgage that requires a monthly principal and interest payment. The product is a reverse mortgage, and through the Federal Housing Administration's Home Equity Conversion Mortgage Program, it can be used to finance the purchase of a home. The National Association of Realtors reported in its 2017 generational trends that older boomers, those currently aged 62 to 70, represent 14% of recent buyers. These folks are typically moving for retirement. They know what they want in their new home, and they don't want to compromise on it. And as we all know, the population is graying, and we need to become familiar with the products and services that can best meet their needs. Before introducing our presenters today, I want to let you know that you can enter questions into the chat box in your GoToWebinar dashboard, and we'll answer as many questions as possible at the end of the presentation. You can also find the slides that will be used today as a handout that you can download from the dashboard. I'm pleased to be introducing Jim Cory and David Heilman. Jim has been in the reverse mortgage industry for more than 15 years. In addition to earning NRMLA's Certified Reverse Mortgage Professional designation, he is a member of the association's board of directors and serves on the ethics committee and as co-chair of the education committee. David is the Director of Sales at Reverse Mortgage USA, a division of Success Mortgage Partners. In 2012, he became the first certified reverse mortgage professional in the state of South Carolina. David also serves as the co-chair of the Greater Charleston chapter of the National Aging in Place Council, and he has a 4-month-old baby at home. And with that, I'd like to hand the presentation over to David.
And I should be congratulated for being on this call and being with it since you just announced my 4-month-old. Thank you for acknowledging that. And everybody, please bear with me. Thank you for being on the call today. And thank you to NRMLA for putting together not only this presentation in support of Reverse Mortgage Education Week, but the host of other presentations throughout the week. So we're here to talk about a financial option for senior home buyers. And this is a little bit of a takeaway, what you'll walk away from today learning. First is what is a HECM for purchase, including the eligibility, property eligibility and loan features. We'll also talk about what are the advantages of the HECM for purchase. How does it compare to other purchase options, for example? What does it mean for contract time, writing contracts and making offers and closing times? What are the expectations there? We'll talk a little bit about do's and don'ts, some required documents that you as realtors need to know, and some product guidelines. And then how does this help you with your listings? And maybe to put it at a simpler way is how does this help you sell more homes? How does it give your buyers more options? Okay, so first, what is a HECM for purchase? First of all, what's a HECM? Jenny kind of mentioned it. You might hear us refer to a HECM in the industry. That's the Home Equity Conversion Mortgage. That's the official name of the reverse mortgage. But we also in the industry talk about reverse for purchase or even H for P. So if you hear HECM for purchase, reverse for purchase, H for P throughout this presentation, those are all commonly used in our industry. But essentially what this does, this allows older homeowners, 62 and older, to buy a new primary residence with part HECM proceeds and part cash assets. So what that does is allows them to put a percentage of cash down and then bring a percentage of loan proceeds without the requirement to make a monthly mortgage payment. And we'll get into more details and do's and don'ts with the product features here in just a minute. But what are the loan amounts based on? And I do want to touch on this real briefly because a lot of people, the first question they have is how much do I qualify for? How much does my client qualify for? So the loan amounts are based on 3 factors essentially. Age of the youngest borrower, the sales price or contract price, maximum claim amount with FHA, which currently for the reverse side is $636,150, that's $636,150, or the appraised value. So the lesser of those, the age of the youngest borrower, and interest rate. Those 3 factors generate a principal limit or a loan amount that the borrowers qualify for. Okay, so we titled this slide a third option because everybody's familiar with an all-cash buyer or a traditional mortgage buyer. And we're going to add another option, a third option, and that's the HECM for purchase. So let's go through the slide real briefly. All cash clients, of course, the advantage to that is they own the home free and clear. That's pretty clear. A traditional mortgage, that's an option for them to put down a minimum down payment, a little bit upfront investment, and then they build equity as they make payments. With the HECM for purchase, the advantage is there's no principal and interest payments required. And this allows the buyer to keep more cash assets for other retirement needs. Some things to consider for all 3 of these. The all cash, of course, it requires a large portion of money up front. And now you've tied that money up, locked it up into the house and not made it liquid. The traditional mortgage requires, as we know, monthly mortgage payments of principal and interest. And this might affect cash flow, especially in retirement. So the reverse from purchase requires a large down payment, yes, but it also allows and has a loan increase over time. But again, it keeps more money at home or with the borrower and allows them to use it for other retirement needs. So let's talk briefly about the eligibility properties. Single-family homes, 2 to 4 unit properties, townhomes, condos if they're FHA approved, which many of you on the call may realize that is few and far between, but there is a FHA approval process and some condos do have the FHA approval. For newly constructed properties or homes, they must have a certificate of occupancy issued prior to taking an application. And we'll get into this and discuss this a little bit more. But this is certainly a challenging spot for new construction and builders, and it requires a lot of education and a lot of discussion, and we'll talk more about this. But this, again, the certificate of occupancy must be issued before we can even take an application for a borrower with this product. Okay, so I've highlighted some of these, but I want to review them. Some of the advantages of going with this product is it preserves much needed cash assets for other retirement needs. So again, and we'll get into some examples here in a minute, but again, it does not take all the cash assets or the majority of the cash assets if the borrower or client is downsizing or right-sizing and immediately puts it into a new home. It allows them to put a percentage of the cash, percentage of financing without a required monthly payment, and therefore preserve cash assets. It might allow them to relocate and move closer to family, or purchase that single family home or single level home, which is more accessible or more conducive for aging in place. And it allows them to right size and move to a more affordable area, less maintenance and less upkeep. And yes, I use the word right size there. We're trying to get away from downsize, and many of you in the industry may know that. Downsizing, when talking to this demographic, is sometimes seen as a negative, as giving something up, and they don't want to be seen as or felt like they're giving anything up. So right sizing instead of downsizing is a good term to start using if you're not already. All right, so let's talk about right sizing. This is a quote we pulled from AARP. I believe I just saw the actual number the other day. I think it's 87%, but they say their statement is nearly 90% of seniors want to stay in their own homes as they age, often referred to as aging in place. And here's an example of right sizing. you have your current home that you're selling, and let's say you have a net gain, just to simplify things, let's say you have a net gain of $400,000 cash you're taking from your current home. And all of this example is based on the minimum age of qualifications for this product, which is 62. So you take your $400,000 cash from your current home or from your past home that you just sold, and you're going to purchase your new home. Your new home is $300,000. The HECM for purchase, or the reverse mortgage for purchase, brings $150,000 financed, requiring you to bring $150,000 from the $400,000 to complete the purchase. So again, $150,000 financed, $150,000 cash. There is no requirement to make a monthly mortgage payment of principal and interest. Homeowners must pay their property taxes, insurance, any other property charges, HOA dues, things of that nature. But what this does for a borrower in retirement is they now have $250,000 cash remaining from their old asset, their old home they just sold. They're in their new home. They don't have a requirement to make a monthly mortgage payment, and they just put $250,000 cash towards other retirement needs. Another idea is upsizing. Last year alone, 4.2 million people in retirement age moved into a new home. That's a big number, but 30% of them actually upsized. So this demographic is, especially the younger, the boomer generation is now hitting, and these are the folks that they want bigger, better things. So they are upsizing, they're buying bigger homes, larger retirement homes. And we usually see, as an industry, we've seen that this product fits an earlier, the minimum age being 62, the purchase product fits that earlier demographic. So this makes sense. And here's an example. Let's say they sell their current home for $200,000 and they purchase their new home for $300,000. They same scenario. It's based off of age 62. They have $150,000 from HECM proceeds. Again, no requirement for principal and interest monthly payments. They have $150,000 cash needed from their $200,000 they're walking with from their old house. That gives them $50,000 cash remaining. But again, they just upsized, put $50,000 towards other retirement needs, and again, no requirement to make a monthly mortgage payment. And now I think we're going to turn it over to Jim for an example.
Thanks, David. I'm going to give some a couple of real-life examples today of loans that we've actually done. These are actual real-life examples. This first one is we had Mr. M, who's moving from a Atlanta suburb to rural Georgia. And a couple of years ago, we did a reverse mortgage on his home in a nice suburb of Atlanta. He really loved the reverse mortgage. It really worked out for him. Soon after, though, his adult children started bugging him to move closer to them and his grandkids. He still wanted the reverse mortgage, though, and still had a reverse mortgage to deal with on the home that he was in. So he ended up getting, was considering this option, and ended up getting a very good offer of $320,000 for his home, for his current home that he lived in. At the same time, or soon after, actually, he found a newly constructed home, or a home that was under construction, for $235,000, and he really liked the idea. And this is much nearer to his grandkids. And he really liked the idea that he could be living in a new home with less upkeep, much nicer, for less money because it's out in the country, and most importantly, would allow him to be near his kids. So how we structured this is he first sold his home in Atlanta. And in doing so, he paid off the reverse lien. He had a reverse lien of about $170,000 on that home. So he clears about $150,000 in equity. The next is the next issue we had to work with is the new home was still a few months from being completed. And David has mentioned that we have to have a completed occupancy certificate before we can even take the application. So this was a sticking point in this loan that we had to work through. We had to explain to the builder's agent this occupancy certificate rule, And in fact, they were they didn't believe us at first, and made us show them, actually made us show the rule in writing. They wanted the closing within 30 days after that occupancy cert was released, so the loan really became getting this loan done became a horse race. We took the app the day after the occupancy certificate was issued. We closed the loan in under 30 days, which was, of course, the demand of the builder. And overall, we were able to successfully navigate the purchase just like we'd have to with a traditional purchase. One of the keys to remember in this program, the reverse for purchase, although we've gone over the numbers and it looks a little different, feels a little different in some ways, the reverse for purchase is still a purchase where it's just the financing is a different type of loan. It still is a purchase. You're still working with the same folks, and you're still getting financing to work through the purchase. The financing just happens to be a reverse mortgage. Anyway,
Jim,
to sum up the numbers on this, yes.
Oh, I just had a couple questions about how this particular transaction went through. So did you feel that the builder's agent and the buyer's agent knew about HECM for purchase before this happened, before they were approached by this particular buyer?
I don't believe that they were aware of that, no. Remember, our buyer was very aware of it as he had a reverse mortgage. And when he called us, he said, what do I do here? I want another reverse mortgage, but I want to buy this home. And so we had to explain it to him. And he and his agent, his buying agent, then went to the builder and builder's agent to explain it to them. So no, this was their first, and that's probably why they demanded to see it in writing.
Sounds like it worked out really well, though.
It sure did.
Did you want to go through the numbers again? Sorry, I know I came.
Sure. Not at all. To sum up the numbers, Mr. M used $95,000 of the $150 that he cleared from the home sale. That left him another $55,000 to add to his retirement, something that David mentioned earlier. And now he has a home near his grandkids with a fixed rate reverse mortgage and no mortgage payment for life. But having said that, with no mortgage payment, we all have to remember that he still has to pay property taxes, homeowner's insurance, usual housing payments, such as if he had HOA payments, has to maintain the property. But all these things, again, it's the same as a traditional loan. These are all obligations that you have as a traditional loan. And so what we have is another happy owner, happy homeowner, and a couple of real estate sales and purchases.
Great.
Now I'm going to turn it back to David.
Thanks, Jim. And yes, Jenny, just to kind of piggyback on your question there, education is the key with this, and it does take it takes the time for all parties involved in the transaction to kind of learn it if they aren't familiar with it. That's why it's really vitally important to, and we'll get into this a little bit later, but to work with someone who's experienced with this type of loan. Okay, so who qualifies? Some of the basics and around surrounding the loan. We've mentioned this before, but it's good to reiterate. Borrowers age 62 or older. This is not a product for millennials, so it's certainly for those in the real estate business who are looking for a way to get into the growing demographic of the boomers and the graying of America, as Jenny said. This is an area you need to know about. So 62 and older must have enough net proceeds from the sale of a previous home or considerable liquid assets to bring to closing. Okay, so we make that statement because there are no borrowed funds. So this isn't the type of loan that'll work if you're going to borrow from an investment property or borrow even from your 401k or IRA to bring the funds to close. So no borrowed funds. We do have to source the funds. Usually it comes from the proceeds, as we mentioned, of a previous home. When there's a relocation, but sometimes it's common, I've had situations where, you currently have people renting and they're waiting to find that right property, and they have considerable liquid assets that they can bring from their 401k, IRA, whatever, cash on hand to complete this purchase. Borrowers can also choose to retain their current home if they qualify. So we put that in there. Qualifying today for a reverse mortgage is much different than it used to be. For a very elementary or 101 explanation, it used to be basically age, enough equity in your home, and and decent credit. So, you know, now today's world, we do have to look more into the credit and the finances of the borrower. So we do have to look at their current financial situation a little more detail. But that's all good and fully supported by the industry. So if they choose to retain their current home, all we have to do is we have to make sure that their income covers their expenses in terms of housing expenses, if they have a mortgage on the current home, if it's being rented or not. All those factors come into play. But essentially the property charges that are on the current home, if their income level is a place that allows it, they can keep that current home and use it as an investment or rent it or whatever the case may be. But their primary residence must have the HECM, or the reverse mortgage on it. And that's my next statement. Must be primary residence, must meet minimum FHA property standards. So this really comes down to the appraisal process, and when the appraisal comes back, those of you in the industry that have done FHA traditional financing knows that there is some different little nuances with peeling and scraping of paint, little things like that that get caught on appraisals. All repairs would have to be done. We'll go into that here in a minute too. But it does have to meet minimum property standards by Federal Housing Administration. Must occupy the property within 60 days. So if you have somebody moving from West Coast to East Coast, maybe they're purchasing the home, but then they're not going to be moving for the next 30 days. As long as they occupy that property within 60 days, they're within the guidelines in the agreement of the product. And then mandatory counseling session. We hadn't mentioned this yet, but all reverse mortgage borrowers, whether it's a purchase or a refinance of the existing home, must attend third-party HUD-approved counseling. This is a consumer safeguard. It has always been in place. I can't tell you how many times I'm talking to borrowers and they're like, oh, I'm so glad that y'all have counseling now. Reverse mortgages have always had counseling. But it is a consumer safeguard. It is third party. It gives the borrowers and parties involved, mainly their adult children if they want to be involved, another voice, somebody to go over the loan program and to make sure it is suitable beyond just a lender. So a very good thing that's in place and always has been in place. Now, the counseling session, I tell people, especially with the new construction, we know that the new construction, we've talked about it, application cannot be taken until CO is issued, but the borrowers who are interested in new construction can start doing some other things, and this is one of them. The mandatory HUD counseling has a shelf life or an expiration of 6 months, I believe, 180 days, I think, yeah. So anyway, that's something that can be done ahead of time. All right, so let's get into some loan features. We've talked about the Federal Housing Administration and what their role is they help insure these loans, and that's what makes them non-recourse. And non-recourse meaning that the borrower and the heirs will never owe more than the loan balance on the property, okay, or the value of the property, whichever is less. So as these loans are originated, the homeowner, the borrower, stays in the home for X amount of years. There is no end date. There is no term on reverse mortgages. In fact, there is one. It's the 150th birthday of the youngest borrower. So something's going to happen before that youngest borrower reaches 150. And so most likely whether the borrower sell the property, that repays the loan. Jim's example is perfect. That was somebody that had a reverse mortgage, repaid their reverse mortgage by selling their property, and then took excess proceeds and purchased another home with a reverse mortgage. But they sell the home or the heirs sell the home, if they owe more than the value of the home, than what the home will bring, they or their heirs or their assets or their estate is not responsible for anything above that. So a quick example, if loan balance grows over time to $300,000 and the house will only sell for $250,000, there's a $50,000 shortfall that the heirs, the estate, the borrowers are not responsible for. Okay, I kind of mentioned this, but reverse mortgages have no time limit. They, technically it's the 150th birthday of the youngest borrower, so something, again, will happen. Either the property will be sold by the borrowers themselves, paid off with other assets, or sold by the heirs. Home ownership never changes. Title never changes. This is still the homeowner's property. It is still owned by the borrower. It is just a mortgage, just like a traditional mortgage would be. So homeowner ownership doesn't change in this transaction. It is one of the biggest misconceptions surrounding reverse mortgages, but title is still in the borrower's name. And they can retain the home for life, provided they continue to occupy the home as their primary residence, keep it in good condition, pay insurance, taxes, homeowners association, things of that nature, which we touched on. And again, borrowers, as a reminder, borrowers are required to attend the counseling by an independent third-party approved HUD counseling agency. As lenders, we are required to give a list of at least 10 to our borrowers, and they are to select. There is no steering or guiding them. They are to select the appropriate from the list. Okay, so writing a contract. These are things that obviously everybody on the call would like to know. I personally always tell realtors that I'm working with to please put 45 days in your contract, and a 10-day extension is fantastic. So if you can be competitive in writing your contracts and still feel comfortable with 45, some lenders even say 60 days. If we can close it in 30 days, like Jim's example, then by all means we're going to try. But writing that 45 to 60 days allows a little bit more time because there are a little bit more moving parts with this transaction. Be sure to put FHA reverse as the type of financing in the contract. Must have a fully executed contract, and it needs to be a certified true copy or an original contract. Now, original contracts are hard to certainly get a hold of, so most of what we see is a certified true copy, and nowadays with DocuSign, that is very easy to do. Excuse me. Must also include the FHA Amendatory Escape Clause, as well as a real estate certification. These documents you would get directly from the lender in many cases, and they need to be included with the contract and dated the same date as the contract. This is another big one, is sellers cannot pay any closing costs. So there are no seller concessions. And I know sellers to pay part of closing costs is very common in writing offers, but with this product, HUD does not recognize any seller concessions, and this goes for builder incentives, upgrades, things of that nature. So basically, the contract just needs to be a final contract price. And I realize that builders do have they have a base price a lot of times, they have their incentives and their upgrades and all these things. But for the purpose of writing the contract, it needs to just say what the final price is without any seller concessions or builder incentives. Seller must pay all the repairs prior to closing. So what happens there is the appraisal comes back, and if there is, of course, a home inspection comes back, and the items that are identified by the underwriter, a lot of times the homeowner identifies items and writes them and puts them on the repair addendum. You're all familiar with that. But a lot of times with this transaction, it goes into underwriting, and the FHA underwriter recognizes something that, a homeowner or either a buyer or a seller might not have wanted or cared about. It would, like chipping and peeling paint, perfect example. Those are things that have to be included and paid for by the seller. So all repairs, my biggest advice here, I guess, is whatever lender you're working with on this product, work very closely with the loan officer to review the review the home inspection in detail, as well as the appraisal, and sometimes even go ahead and get an FHA underwriter review so that it doesn't hold up the transaction. New construction, we've mentioned this, and this is another kind of quirky thing, but we need to keep in mind when we're writing contracts and dealing with clients that are looking at this product, must have certificate of occupancy for the new construction. So writing offers and getting under contract, we have to, it's fine for new construction. You can document all the draws, all those things, but we can't even apply for the loan until the certificate of occupancy is in hand. And now, Jim, if you would take over and give us another example.
Will do. Thanks, David. Okay, the next example is about Ms. K, who was looking to buy a home in Oceanside, California, which is in North San Diego County. And she was looking at a home in the 300 range. Now, there's a backstory on this one, and it's kind of funny. I don't know how I managed to pull two examples where they both had other reverse mortgages involved, but I did. And the backstory here is that she and her husband, or more accurately, ex-husband, had just divorced. He wanted to keep the house. They had a small house, and he wanted to keep it in part by paying her share with a reverse mortgage, which is a transaction that I've seen, a different transaction I've seen, and one that does work. But we're not here to talk about the traditional reverse mortgage like that. In this case, she found a home near the beach for $300,000, and I should mention, if it's near the beach for $300,000 in Oceanside, this is, if anyone knows the area, this was quite a few years ago. So we get a purchase agreement for $300K. We take the application for a fixed rate reverse mortgage that provided $170K in financing. She uses $130K from members, that's from her ex-husband and from retirement accounts. Some of that was from that reverse mortgage that her ex-husband got. And now she ends up doing the transaction. Purchase price $300, reverse mortgage $170, $130 down payment. Now she's got a new home near the beach, no monthly principal and interest payments. As per usual, she does have to pay taxes and insurance, just like a traditional loan. And here we have another example of a happy homeowner, another home sale, another home purchase. And now I want to get into the from contract to closing.
Hey, Jim.
Next slide. Yes.
Real quick, I noticed on this example, all the prior examples we've given have kind of been a 50-50 thing. This is a good place to point out. She obviously wasn't 62. She was, do you have an idea how old Ms. K was?
More like 70, yeah. And
yeah.
This was a few years ago as well.
Right. So the older you are, the more reverse mortgage proceeds you qualify for towards the purchase. So again, all of our examples to this point have been at the minimum age of 62. Therefore yielding a roughly 50% loan proceeds. So the older you are, the more loan proceeds, therefore less cash needed to purchase. So just wanted to point that out.
Good point. Thank you. All right, and I've mentioned a couple of times in these examples, and I like to mention how the reverse mortgage is so similar to a regular mortgage. And it's really exemplified in the reverse mortgage for purchase. We have the closing process. The whole process is going to be, you're going to find it's going to be very, very similar. It's another loan. It's another vehicle for financing. So it's a similar closing process. The things to consider. You're going to have two of the bigger differences is a buyer is must meet with a HECM counselor, right? They have telephone counseling, sometimes it's done face-to-face, but they have to, every single transaction, every single one of these transactions, there has to be this HUD-approved reverse mortgage counseling. I like to tell buyers and clients, some of them look at it as something they have to do. I like to say it's something they get to do. You get to ask these questions of a third party who is approved by the government to do this counseling. You get to ask them these questions. You get to hear some other options. You get to hear how this might work for them. The other thing is, and David mentioned this, you might consider a 60-day contract. I think more commonly in the industry, as David pointed out, we do 45 days. It can do 30 days. But why does it take longer? Well, these HECM for purchases are very highly scrutinized by HUD. They are FHA insured. Every single one is looked at by HUD. And so what you have is lenders and underwriters doing these very, very carefully. It just takes a little longer. There's no problems for the client. Most of it falls on the lender to take care of, but there is a heavier amount of scrutiny that does require sometimes a little bit more time. And that gets into my next point, which is the do's and don'ts. And do work with a certified reverse mortgage professional. These are not easy transactions, again, not the standard reverse mortgage transaction. I particularly don't think they're tough transactions, but I am a CRMP. David's a CRMP. You'd want to work with a loan officer who is a CRMP and make sure that their company is a member of NRMLA. Any CRMP, their company will be a member of NRMLA. Another one is, for the don'ts, is don't add any seller concessions. We mentioned before that you can't have a seller concession. What this means, oftentimes the contract will have one in it. Get ready for a contract addendum or two. Sometimes we'll have two addendums, just trying to get it right. And we see this especially on your first couple of reverse mortgage for purchase transactions. Don't be afraid of the contract addendum. Often can solve everything, but you're probably going to see one. And finally, I always tell folks don't get a buyer's inspector. I tell the seller, geez, the buyer, when they get the home inspection, don't get a buyer's inspector, as I like to call it, who beats up the place with a huge report to influence the seller to make concessions. I know that sometimes happens in the business. I know that there's different, when you have a home inspector, you're going to have a home inspector that wants to get the place to sell, and you can have one where maybe the buyer wants to grind the seller a little bit. There can't be any seller concessions, so it can only cause problems. You really don't want a HECM for purchase underwriter getting their hands on a report showing all kinds of potential repairs needed. Finally, reverse mortgages, I think, have sometimes been seen as an enemy of a realtor, and it's not the case at all. With the reverse mortgage for purchase, it's just a fantastic way to finance a home purchase. Benny?
Thank you so much, Jim and David. The information that you provided has been just, I think, so useful to anyone who's learning more about HECM for purchase, particularly realtors and agents who are trying to think of more options that they can be offering to their buyers, especially these folks who don't want to compromise on their retirement home. We have some great questions from the attendees that I want to start posing to you guys and see how many we can get through, because there's a lot of good questions here. So there's a bunch about closing costs. Now, if the buyer is trying to negotiate with the seller to pay closing costs, is that considered a concession?
Sorry, I had my phone on mute. Jim, jump in if you want, but yes, I mean that's exactly what we're talking about. So closing cost concessions, seller concessions, just end up working it into your final agreed upon price.
Absolutely, that's what it really, it's just that business traditionally sees these the contract written a certain way, and really the numbers turn out to be the same. We just have to see it written a different way.
Great. Here's another good question. Can you let us know how people can find out how much of the home price the reverse mortgage would cover? Is there a way to just generally get that type of information if there was, if people were wondering about that? I'll answer that one. You can find a calculator on our on reversemortgage.org. There's a reverse mortgage calculator there. So when it asks for the value of your home, you would enter the value of or the purchase price and your age and the other information requested.
Yeah, and Jenny, real quick,
Yep.
if working with a certified reverse mortgage professional or somebody in our industry, they're more than likely going to have access to a matrix. I know when I'm dealing with realtors, I give them, you know, a marketing piece that kind of has a matrix on there that breaks down different ages, different home values, and what you can expect your client to qualify for. So yes, that information is out there. If you find a good lender to work with and partner with, they'll be able to provide you with that. But to find out, as Jenny mentioned, any reverse mortgage calculator will help you do that too on reversemortgage.org.
Thanks. Here's a great question, which is, how do we answer the question, why can't my bank do a HECM for purchase?
I'll give you my opinion on that, and Jim can chime in. Certainly, there are banks and credit unions that do reverse mortgages, but it's not common. And the reason for that, in my opinion, is that this is a highly specialized loan, and it takes a lot of education, a lot of hand-holding, and it really, again, kind of points to the importance of working with somebody that's in the industry every day. Banks and credit unions are very transaction-oriented and just geared that way. So this is, again, a more in-depth, hands-on is the best way to describe it, educating all the parties involved, from realtor to builder to consumer to family members to CPAs. I mean, it can go on and on and on, the people that get involved in some way or another in the transaction. So it is a very kitchen table kind of transaction, face-to-face consultations, things of that nature. So banks and credit unions just aren't really set up for that, in my opinion.
And I agree with that sentiment, David. I think also that there's just a heavy amount of regulation on this. And I think it just takes a lot of experience to know that, and the players that are in the business are committed to it and know that it's a niche product that it's going to take an awful lot of regulatory and compliance work.
Thanks. And here's a question. Can you explain the closing costs for the loan itself?
Yeah, that's a good one. There is, on the purchase transactions, there are no lender credits or anything like that. So you're going to see, typically with a purchase transaction, you more than likely will not see an origination fee. Some may charge origination fees, some may not. So then the other fees are going to be customary to any real estate transaction, as far as you know, third-party fees, title insurance, attorney, closing fee. All those things are going to be normal and customary, as well as appraisal. Where you're going to see the biggest difference is the upfront mortgage insurance premium, and we've talked about the Federal Housing Administration and their role to insure these loans, but I always tell people they're not going to do it for free. So it is on the purchase transaction, and this can, I mean, we could go into more in depth into this, but there are two levels of mortgage insurance premium, upfront mortgage insurance premium built into this. There's a 0.5%, and then there's a 2.5%. Now, with most purchase transactions, it's going to be the 2.5%. So you take your home value 2.5% are your contract price, 2.5%, that's going to be the upfront mortgage insurance premium in most cases.
Thank you.
That's right. There is a way to, some call it overfunding a reverse mortgage for purchase transaction to get the mortgage insurance premium down to 0.5%. I don't have the time to go into it today, but I would say talk to a CRMP and ask them about that if you're interested.
Thanks. Here's a question. How do you convince the builder to delay the closing?
Go ahead, Jim.
I'll take this one because I dealt with it. You just do. I'll have a better answer than that. But no, we literally, in this particular case with Mr. M, we actually had to pull out the regulation and show the builder and show him where HUD specifically made us delay that transaction until and we couldn't even take the application until that occupancy cert was released. You know, when you show somebody the regulation, we worked with them heavily to make sure that they were still interested, and eventually they agreed to it. I think from the builder standpoint, we had such a confident buyer, and we had such his down payment funds were very solid. He was a very solid borrower as far as the financing goes too, because the reverse mortgage, there are some qualification hurdles, but there's not like an income qualification hurdle where the borrower loses. There is, but it's generally more based along Social Security and some of the pension and things. And there's not like a job loss that could happen and change the mind. So the builder was willing to go an extra couple months with us while the building was being built.
I've also heard, sorry, go ahead.
Yeah, go ahead.
I was going to say, and you guys can speak to this, but I've also heard that one of the things that builders like when they understand how HECM for purchase works is that because it's giving the buyer a little bit more financial flexibility, that they are more likely to get some upgrades that maybe they wouldn't have been able to get before they had this flexibility in their financing. Is that something that you've heard?
Great point. Yeah, we've experienced that actually. It's we've had a local builder here that got it, and once you get a builder that really gets it, again, the importance of working with a professional in our industry, they're going to take the time to educate your builder or your relationship that the realtor might have with the builder. They can help with that, so don't feel like you have to do that on your own. If they're knowledgeable and wanting to work with you and your building partners, then they're going to take the time to do that. But I have found in dealing with builders, most of it is a one-on-one kind of education, literally getting on the phone with the owner and having a conversation so they understand the product. Once they understand it, they really feel more comfortable with it. But that's exactly right. What you just said, Jenny, will once they see the product and how it works, they'll see that this opens up their buyers for more flexibility, as you mentioned. So that's a great point, and it can help you help the builder sell more house, help the agent sell more house.
Great. Here's another question. In terms of non-borrowing spouses, how does that rules for non-borrowing spouse, how does that impact a HECM for purchase? Is it different with the HECM for purchase than typical HECM?
I'll give this one a shot. That's a new question to me. I have not seen that type of transaction. I'm sure it's being done, but I'll take a shot with it. Which shouldn't affect the transaction. There's two types of non-borrowing spouse, ineligible and eligible. Eligible means they live in the home. In this case, if the non-borrowing spouse was purchasing the home with the borrower and going to be moving into the home, then that would be an eligible non-borrowing spouse and could affect the amount of funds the borrower could receive if the non-borrowing spouse was younger. The non-borrowing spouse would then also get some of the protections of the reverse mortgage as far as being able to stay in the home after the borrower passes. If it's an ineligible non-borrowing spouse, it would affect some of the paperwork and as with any NBS, would have to be counseled, but I don't see any change to the transaction from that.
That's helpful. I'm sorry if I missed this in your answer, but does it affect who can be on the title of the home?
Currently, yes.
Yeah.
The non-borrowing spouse cannot be on title to the home. So I probably misspoke a bit because I said the non-borrowing spouse would be purchasing it or moving in with the spouse. Rather than
the non-borrowing spouse is not on title, but they do have some protections if they're an eligible non-borrowing spouse. But they are not on title to the property, and they also don't have any access to any loan proceeds. If there's, this is getting way into strategies, but if there was an overfunding of the purchase, for example, the non-borrowing spouse would not be eligible for any line of credit proceeds. The other thing to consider is a non-borrowing spouse, an eligible non-borrowing spouse, we have to use their date of birth. So it can affect how much the transaction, how much proceeds are in the transaction.
Thanks. Here's an interesting question. What is the minimum FICO score for this type of financing?
There is no FICO
score? Yep.
There is no minimum FICO for a reverse mortgage.
Great.
Right. No minimum credit score, but we do have to review credit in mainly looking at how many 30, 60, 90-day lates on revolving and installment accounts.
Can you gather
the score doesn't matter, but the score doesn't matter, but the history does.
Right.
Can you gather documentation prior to the CO an application date in order to provide a pre-approval letter to a builder or a seller?
We often do provide pre-approval letters based on the borrower's documentation, but the application cannot be taken before, in the case you're mentioning, the application can never be taken before the occupancy certification. So some of the documentation, if you're talking about documentation like an appraisal, that would not be eligible, no.
And how is the appraisal determined when we're working on a HECM for purchase? Who orders the appraisal?
The lender orders the appraisal. Just it's a standard, the same methodology as a normal purchase or as a normal mortgage transaction. The lender's going to order that appraisal, and it's going to be an FHA appraisal.
And they're going to include the contract just like they would with a traditional financing.
Great. Here's a question from a HECM counselor who said that she had a client call her and say that he wants to do the HECM for purchase, but he and his wife are divorcing and he wants to do the transaction without her. Would she be required to be counseled?
Absolutely.
I would say yes, they're legally married.
I like to say a spouse is a spouse is a spouse when it comes to non-borrowing spouse rules.
Now, if she's not living, we're not counselors, so I don't know if I totally feel comfortable answering that. But from my experience, that would be an ineligible non-borrowing spouse if he or she if they're not living together. Still legally married, not living together, but still have to be counseled.
Thanks. So here's a question on the FHA Amendatory Clause. What is that?
Jim, you want me to take that?
Go for it.
Is basically it gives them an escape, gives the buyer an escape if they aren't happy with the appraised value or the repairs that come back on the appraisal or something of that nature. So it gives them the out.
Great.
Without penalty. get out of the contract without penalty.
And how does HECM for purchase impact the compensation for the realtor?
It doesn't. It's no different than any real estate transaction. Your commission as a realtor is going to be the same if they're paying cash, if they're paying traditional financing, or if they're paying with a reverse.
Great. And
It's
you...
so similar to traditional financing, as we've said all along.
Can the borrower draw on HECM for improvements? How would that work?
If a borrower was to not take all the cash allotted to them up front and have a line of credit, then they could have later money available in a line of credit, for instance, that they could use for that sort of thing later, if I'm answering the correct question.
Yeah, essentially if the borrower puts more down payment, then they would establish a line of credit.
Well, thank you guys. We are coming up to the very end of the hour here. I want to make sure to let all of our attendees and listeners know that if you have additional questions about reverse mortgages, please visit our website, reversemortgage.org, where you can find our free guides for consumers providing information about how the loans work, how they get repaid, and also they answer a lot of questions about what happens for the kids of borrowers and the heirs of the borrower. And I encourage you all to look for information there. You can always contact us at the National Reverse Mortgage Lenders Association if you have additional questions. And we really appreciate all of your time for participating today. Thank you very much.
Thanks, Jenny. Thanks, everyone.